Welcome to Business Book Daily. Today I'm breaking down a book about investing, patience, and why ordinary people often do better when they stop trying to outsmart the market. I'll cover the big idea, the practical business lesson, and three sharp insights you can use right away. Let's get into it. But first, a word from our sponsor. Want to sell more without adding fixed payroll? A lot of smart operators hire commission-only reps, experienced sellers who get paid only when they produce results. If that sounds like a smarter way to scale, post your opportunity at commissiononly.com. Thousands of motivated reps are actively looking for performance-based roles right now. Commissiononly.com. Today's book is The Little Book of Common Sense Investing by John C. Bogle. Bogle was the founder of Vanguard and one of the most important figures in modern investing because he helped make low-cost index funds available to everyday investors. His core argument is simple. Most investors should stop trying to beat the market and instead own the market through low-cost index funds. That's what makes this book useful. A lot of people think investing success comes from finding the perfect stock, hiring the smartest fund manager, or timing the market just right. Bogle argues that those habits usually hurt more than they help. The real edge is much less exciting. Keep costs low, own a broad slice of the market, and stay invested for a long time. The book makes a clear point. Investors often lose not because the market fails them, but because they pay too much, trade too often, and chase performance after the best returns have already happened. One of the strongest ideas in the book is that low costs are a real advantage. Investors can't control the market's return, but they can control how much they pay to participate in it. Fees, commissions, taxes, and trading costs quietly reduce long-term results. A fund that charges less doesn't have to be brilliant to beat many higher-cost options. It simply has less drag. Another key lesson is that indexing beats most active management over time. That doesn't mean no professional investor can ever win. It means the average person has poor odds when trying to pick the winning manager in advance. Index funds avoid that game by owning the whole market. Instead of betting on prediction, they bet on participation. The book also separates investing from speculation. Investing means owning productive assets and letting time do the work. Speculation means trying to guess short-term price moves. Speculation feels more exciting, but excitement is not a strategy. A steady plan often beats constant movement because it avoids panic selling, emotional buying, and chasing whatever worked last year. There's also an important lesson about compounding. Compounding needs time and discipline. The math is not the hardest part. The hard part is staying invested when markets are scary, noisy, or euphoric. Most people don't need more market opinions. They need fewer moves and a plan they can actually follow. Another useful idea is that simplicity protects people from bad decisions. A complicated plan gives people more chances to tinker, panic, or convince themselves they found a special edge. A simple plan is easier to understand and easier to keep. That's the point. So how do you apply this? Start with your company's retirement plans and financial benefits. If your 401k or retirement plan is filled with high-fee funds, confusing choices, or expensive managed products, employees may be losing money without realizing it. A better plan gives people simple, low-cost, broad market options they can understand and use. Next, apply the same thinking to business decisions. Leaders often overpay for complexity because it sounds smarter. They buy elaborate systems, hire expensive experts, or chase trendy strategies before asking whether a simpler option would work better. Every extra layer of cost needs to earn its place. Then make good decisions easier for your team. If employees are expected to save, invest, or choose benefits, don't bury them in jargon. Clear defaults, plain language explanations, and low-cost choices can help people make better decisions without becoming finance experts. After that, watch for performance chasing in your own company. Investors often buy last year's winning fund after the best gains have already happened. Leaders do the same thing when they chase yesterday's hot tactic, platform, or market trend. The smarter move is to focus on durable principles: low cost, broad participation, discipline, and patience. Finally, treat hidden costs as strategic risks. Fees, complexity, vendor markups, unnecessary activity, and turnover can quietly drain a business, just as investment fees drain a portfolio. Small leaks matter when they compound. Now, here are 3 insights worth sharing. First, in investing in business, boring systems often beat brilliant predictions because they reduce the number of bad decisions people can make. Second, the most dangerous costs are the ones that look small, repeat often, and compound quietly for years. Third, most investors don't need more market opinions. They need lower costs, fewer moves, and a plan they can actually follow. Today's closing sponsor is memoirghostwriting.com. Many of the best business books start as ideas leaders have been refining for years. Memoirghostwriting.com works with founders, executives, and industry experts to turn those ideas into polished business books that build authority, attract leads, and open doors. They handle everything from interviews to writing, to editing, to publishing. If there's a book in your head that should already be helping your business, learn more at memoirghostwriting.com. That's it for today. See you next time.